This is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, January 9th, 2019. Let's start with the daily charts right now of all the major index ETFs, at least those that I follow. We'll start out here with SPY. As I mentioned, there's just a ton of overhead resistance. You can keep adding lines here, but probably where it really gets thick is right about here. I'll color that line yellow. I know, let's give it another color because I want to talk about this 50-day EMA. All right, so we'll make it blue. You have, of course, reactions there. There's reactions on all these lines, and we've just been shooting right up through here. Remember, this is like a slingshot or rubber band. The rubber band was extremely stretched to the downside, therefore you snap back. But what you can see here, the momentum is clearly waning. Look at the size of these green candles. It's like Russian dolls. Those dolls you stack on one on top of the other, and they're increasingly smaller as you pull one off. And that just shows waning momentum. So as we come up here, I can point out resistance levels all day long, but a couple that I want to highlight here are or at least at this point in time, is a 50-day EMA, and I'll make mention of that level there because there's quite a few. That was a key support level right there around 260, 250, and just to quantify it on SPY now, if this uptrend happens to continue, I still think we'll get a decent tradable pullback soon, and I'm still longer term, intermediate term bullish, intermediate term long, and all my long term accounts, but looking for a pullback here. So maybe another, at this point, I think it probably at best another 1% upside, and I'd be surprised if we even made that much more before we pull back another 2%, 2 to 3%. Now you can see the SPY has plenty of room before it hits the 50-day, and the 50-day is a key. I like to use EMAs. Some people use SMAs, simple moving averages. The EMA is the exponential moving average. Keep in mind, with all moving averages, they work well during a trend, and like all trend indicators, don't even bother paying them attention when you're in a choppy, grinding, sideways market. And what am I talking about right here? This was a bunch of chop right here, a sideways choppy fest, and you went through the 50-day like it wasn't even there. The 200 is a longer term, and it did come in as support on the bottom. I mentioned that many times. But during volatile markets or sideways market, trend indicators, moving averages used as support or resistance don't work as well. However, during an uptrend, they do. They do a great job. You can see how the 50, and of course, you don't have to have it to the button. There's a few brief pierces below, but you can see it does a good job. And it also on the way down we had a couple, that was just a 1-day pop below, and then we failed after that 1-day candle right there, one single candle. We went down, closed well below it the next day. And let me just show you one other chart. Going back, this right about here, or right exactly here, was the market top in October of 2007, the last bull market. And I have made some comments. I've made some comparisons to the last bull, and I also said I don't expect this bull or the next bear market to play out exactly like the last one did. But what I want to show you here is the importance of the 50-day and the 200-day. Those are the two I like to use the best. There's some other moving averages on different time frames that work well. But what I'm looking at here, let's just zoom in. All right, so this is where the initial leg down, which was a 20.4% drop, very similar. The SPY this time, or the S&P 500, I'm sorry, dropped. I'm going from memory. I think it was 19.97% or something. So almost right about 20. Rounded off, they're both 20% drops. The initial thrust down off the highs. That's your leg one down, or wave one, and if you're Elliott waver in that bear market. And then we had a nice rally. You can see here, and I've covered this before, it was about a 14.8 or call it 15% rally off there, and that's what I think we're trading now, first leg up. And it stopped, just to kind of look at all the numbers here. It popped just above the 51.8, fell well shy of the 61.8% Fibonacci retracement. And for those of you not familiar with what that is, I'm measuring the move from the top to the bottom of that initial leg down, and so those are the Fibonacci retracements. So it means we retraced, regained about half of the drop, and then the bear market resumed. And again, that was about a 14.8% kickback rally. Now, what I wanted to point out is the 50-day, once you start trending, it works well as support and resistance. And, I expect it to get taken out this time around. However, It's been my experience that when you have a well-watched trend line or a well-watched moving average, it's usually that initial tag where you get a reaction. By initial tag, I don't mean the very first tag. By definition, there's tags all over here of the 50-day, and it's been cut through. I'm saying when you haven't visited in a while, when you haven't touched, when you've been well below that line, this is an initial tag in my book. Boom, rejection. And again, we're looking at the red line here, the 50. We came back up off the lows. Right here was the lows, the initial leg down. Boom, hit the 50 and pulled back. Now that may not look like much, and it wasn't, but it's also I'm not looking for much now. I bet you that was about 3% or so. I could measure it out. I'm just eyeballing it. Probably a good 3% or so move, and that's again about all I'm looking for right now. And then we went through it and started chopping through it because this uptrend continued. And I think we'll see something like that now. Not because I'm focused on what happened back in 2000, and that was at this point it was 2008. But more so just based on where we are and where my analysis has been recently, looking for some more upside in this in the rally that started off the December 24th lows. And then once you get back under, once the next leg down resumes, we can then look forward to that likely capping a lot of the advances like it did back here. Once you can see, once the next leg down started, and he pushed back to the 50-day, and there were many of them, were a gift. It was literally a present wrapped in a ribbon, delivered to shorts to just go ahead and short that 50-day. Might not always work out that way, but you can see without fail after the initial counter trend rally, and this is where the big gains were to be made in the 2008 meltdown. Every single instance that the market kicked back. And, when you have a lot of strong movement, this is a 28% counter trend rally. Yeah, we pierced above it a few days. You just have to expect that when the markets are moving fast. I call it momentum fueled overshoots. When you have a lot of velocity coming up to a resistance level, momentum will carry you through that level often. So you just sometimes, especially when volatility is high, you have to give it room. Right now, volatility is not that high. It's abated. We're moving up, but you can see, as I just showed you, let's go back to where we were, get back to the chart we were on. Like I said, I use the analogy of the Russian dolls. Looking at these, the green candles are getting smaller and smaller. That is volatility, the intraday ranges, the daily ranges slowing down. And so let's look at a few others before we move on here. So there's QQQ, and again, what did I say, about 1% up to that 50-day, maybe a little less on SPY, that is. So here's QQQ. Boom, coming right up to the 50-day. So again, the 50-day has just done a bang up job of acting as support and resistance. Sure, sometimes you shoot through it a little bit, but you can just go back in time. Yeah, when you're in a meltdown mode, volatility, bouncing back, stay away from trying to use trend indicators and trading off the 50. But once you have an established trend, like you did here, this is an uptrend. You're in an uptrend, the 50 should act as support, buys pullbacks to support. Boom, you went down through it impulsively. There was a lot of other sell signals that I highlighted back then at the time, major sell signals on the market. So that told us that break wouldn't be one of these little whipsaws like back here. That said, that was a real deal, and we were short on that. And then at that point, you're well below it. So then you look for those initial kickbacks to the 50. And like I said, that was one single day that it popped above and closed above it with a violent rejection the following day. And this is the first tag, almost there. I mean, I'm not even going to bother measuring it from the highs. That's less than 1%, I can tell you right now. Close enough. So we'll see. Maybe we go through it. Maybe 1 day, 2 days. Maybe we don't at all. Bottom line is we're there on QQQ. Let's look at that. So those are the two big large cap indexes I follow. I hardly follow the Dow. It's only 30 stocks, but we'll look at it. The Dow looks similar to S&P 500, so let's just about maybe 1% or so there. Mid-caps coming up on some really nice resistance here. You have reactions from here, here, here. A lot of reactions there. About a week we traded on that level, and then boom, broke down, and then we had a waterfall sell-off once that support gave way. We're coming back up to that now. So first and foremost, that's major price resistance. Then you have, yes, the 50-day, that yellow line coming up. So like I said, the risk reward is rapidly skewing to the very near term. I'm talking active traders. Continue to maintain. I believe in anything can happen, and I'll be, wide open to any changes in the market that change my view. But at this point in time, I'm just looking for a reaction off there to game, and a reaction 2-3%. If you trade that on SQQQ or futures, NQ or even the ES futures, you get a little more bang for your buck trading NQ. I think the small caps right now, we're going to get to that next. That's probably where you'll see the biggest bang for your buck here. I think in the next within the next week or so. So that's something that I'm looking for there. And again, minimal upside, maybe from where we closed today, not even the highs, so about a little over 1% till we get to that resistance level. Quite often when a lot of eyes are looking at the same level, all those that are long here or wanted to, or shorts that want to short that level, longs that want to get out, you may see them step in early. It's possible they pop above it. Look, I don't know. I've been saying for the last about week or so now, my convictions aren't super high. My positioning on my active trading accounts isn't high. I'm not doing anything with my long-term accounts yet, as far as the broad market stuff. But I do think we're going to see probably a reversal before we even get to that level. And then, of course, IWM, just a nice looking chart here. IWM, we have, I had a price target right here at 143.88, but the actual resistance level, when you see the pop-up box there, is 143.96. Let's call that 144. So we came very close today. That is also the 50% Fibonacci retracement level. You can't even see it there because it overlaps that line. I've had that line there for weeks now. And the Fibonacci retracements right over here, here's your 32.8 fib, comes in perfectly with that, what I say, 144-ish level. As well as the 50-day. You can see the 50-day moving average coming down. It's done a great job of containing this uptrend, or I'm sorry, the downtrend so far. It did a great job of containing the uptrend, other than this sloppy, correction period we had right here. And so I think we'll probably get a decent reaction off there. And again, that's what I'm looking for, something like this. Maybe back to my former first price target there. And then maybe another thrust up and probably come and take out that, test that 200. And same thing, when we get near that 200-day, I'll probably be doing a similar video talking about that. But we'll see. It needs to align with other things. I don't trade off just to moving averages. In fact, I'd put a higher weighting on price resistance levels than I do moving averages. And some moving averages do a better job than others. I want to say that right now. I never trade off or even put much of a weighting on a moving average if I pull up a stock or an index and the prices have sliced through that moving average like a hot knife through butter, like it wasn't even there. And I'm talking consistently. And you got to look back a long period of time. So there are some moving averages, even the popular ones, 250, 200-day, 50-day, 100-day, that may do a great job on a certain stock or an index, acting as support or resistance, and then on other stocks or indexes, you need to change it. So sometimes I'll go in and change the settings, and I might find, let's say instead of a 100-day, maybe I pull it down to an 88-day or something, and I change the settings to see a moving average that fits that particular stock or index. But in this case, the major indexes, these are the ones traders have used for years, whether it's a self-fulfilling prophecy or not, because everybody uses the 200 and the 50 days. And again, you can change it to an SMA if you want. They usually come in together. The EMAs move a little faster because their calculation used for an exponential moving average will tend to the averages will react to prices a little bit quicker than the simple moving averages. Here's the by the way, the small cap, the Russell 2000 futures RTY. You can see the same thing on a daily chart. There's that clean bearish rising wedge. Like I said, this correction was seen coming, for miles. Once we broke down, it was just a waterfall type sell-off. It actually exceeded my, downside target, and I had some pretty aggressive downside targets, I think about right here when we were back up at the highs. So we undershot it, and that's what happens. Over momentum fueled overshoot, and that's why I was looking for such a sharp rally, because we got oversold, too oversold, especially based on where the economy is, everything else I talked about. So again, I do think there's probably some more upside to come, but I wanted to point out here on the futures as well, just a nice kiss of the 38.2 Fibonacci retracement, again, from the move off the highs to the lows. And that is the small cap futures. So, and they've also come up quite a bit. They've been very strong. I think they've been outperforming. I have to look at the figures, but it seems to me they've been outperforming the large caps recently. And that's usually the case, not always, but often the case. They're faster growth rate companies, and it works in reverse as well. They tend to fall harder when they correct, and they tend to come back harder. So again, I think there's probably going to be more bang for your buck. So in order of favorites, I would say IWM, then QQQ, and then SPY as far as the big three that I track. And to just wrap up with the futures, sound like a broken record. We just keep wedging up. And again, we're losing momentum. We're not really moving up that much right now. QQQ today was up. QQQ was stronger than everything else, up a 0.81%. And the small caps were up, but the SPY was only up about a little under 0.5%. So we are moving up, but we've hit that next target that I had, 66.49. Remember, these were targets all the way back here a long time ago. So we've hit those targets, and I can tell you right now that's about my max target for this leg up before we get that decent correction. So who knows? It seemed like it was coming for days now, and in time. It's one thing to be early on time, but a different thing to be way too early on price. So again, prices haven't moved up that much. We're talking a few percentage points. We had this breakout here. We back tested, and I think right about here is where I started looking for the pullback to come in back test, or right here. So come and back test this level. And I still think we do. And that level again is 64.10. We now need to extend this uptrend line if I can grab it. And I don't know why it doesn't want to cooperate. There it is. And they come in together. So at this point in time, let's simplify things. I have one sole pullback target on the futures because that 64.10 50ish level comes right in with the trend line if it happens soon. Remember, trend lines and charts are dynamic, so every day goes by the trend line comes in at higher and higher levels. But as of now, if we can get a decent pullback here this week, early into next week, 64.10.50 be a good place to cover any short active trades on the short side, and or add to or recycle back into some long trades there. And finally, to wrap it up, ES, the S&P 500 E-mini futures, same story. It's almost mirroring the NASDAQ 100 futures right now. And I have the same, well, obviously different levels, but they're the same level, that key level I was looking at for the breakout there, 25, 22, 50-ish. There was our breakout back test. We moved up, hit that target. That was a resistance level I've had on this chart for quite some time, 25.94. That's been pretty much a brick wall in the last couple of days, and I'm still expecting a move down here like this, and then boom, hopefully that will provide us a long entry. We'll see. And if anything else happens, break below that level, you can see some additional supports below that should come into play. And I really, at this point in time, would like to see this level hold to keep the bullish case intact. It's not my be-all, end-all, or my max threshold, but that would be, let's just say, my maximum downside target if things got ugly here, and that's about 24.70. And again, this is my preferred target area, and we'll just have to take it from there. All right, let's wrap it up here, and we'll continue this tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it, and have a great day.